Okay, so this one says, exercise 5.2, page 542, that's funny, 5.2, 5.42. Exercise, oh, it's not on 5.42. No, it's exercise 5.4, that's why, I was looking at the wrong one. 5.4 on 5.42. Okay, the following transactions are for Alonzo Company, and there's a 1, 2, and 3. And instructions say, A, prepare the journal entries to record these transactions on the books of Alonzo Company. Alonzo uses a perpetual inventory system. And in this chapter, everything you do is going to be perpetual inventory system. All right, so number 1 says, on December 3rd, Alonzo Company sold $500,000 of merchandise to Artie Company on account. Terms 1/10, N/30, so that's 1% 10, net 30. The cost of the merchandise sold is $330,000. Okay, so to make a sale, we know that we have to have 4 lines, 2 entries. Okay, so the first entry is to bill the customer. So December 3rd, it says it's on account, so we know it's accounts receivable, and it also gives us terms, so we know it's accounts receivable. So we are going to debit accounts receivable for the amount they sold to the customer for, which is $500,000. And we are going to credit sales revenue for the amount that we sold it to the customer for. Okay, so that's the first part. That's to enter the transaction of the sale. The second part is to record the cost of goods sold and to get the item out of inventory. So we're going to debit cost of goods sold. And we're debiting that for the cost of the goods. And then the problem, they told us it was $330,000. And then we are going to credit inventory because we sold the item. We're taking it out of our inventory. So we're crediting inventory, $330,000. All right, number 2. On December 8th, Artie Company was granted an allowance of $25,000 for merchandise purchased on December 3rd. Now, when it is an allowance, we do not have anything to do with inventory. We're just giving the customer credit when it's an allowance, okay? So, December 8th, we're going to be debiting the account called sales returns and allowances. And we're debiting that for the amount of the allowance, which is $25,000. And then we're going to be crediting accounts receivable, because we're giving our customer a credit. And that's $25,000. All right, number 3. On December 13th, Alonzo Company received the balance due from Artie Company. So the first thing you want to do is look and see, is it within the terms to get the discount? So these terms were 1/10, so that means they get a 1% discount if they pay within 10 days. So they bought the item on or you sold the item to them on December 3rd. The customer is going to pay it on December 13th. So that is within 10 days. As long as it's postmarked on the 10th day, it counts. So December 13th, but we have to do the math to figure out the entry, right? And so below here, I have the little formula. So we start with our sales, right? What our sales were. So our sales were $500,000, right? Minus any returns or allowances. And we had an allowance of $25,000. So we're going to subtract the allowance of $25,000. Oops, I put a period. There we go. And that's going to give us an accounts receivable number of $475,000. Okay, so the accounts receivable is $475,000. We're then going to take the $475,000, which is the accounts receivable number, and we're going to multiply it by the discount percentage amount. And they told us that it was 1/10, so that means 1% discount if they pay within 10 days. So 1% of, so 475,000 times 1% is 4,750. And oh, I'm going to move that up a line. Okay, and then we're going to take the accounts receivable number, 475,000, minus the discount dollar amount of 4750. And that's going to tell us how much the customer is actually going to pay us, $470,250. Okay. So now we have all the numbers we need to do the entry. All right. So what do we get? Well, we got cash because we're getting paid. We got cash. And how much cash do we get? Well, we figured it out down below. That was the last thing we figured out. We're getting $470,000 to $470,250. Okay. All right. The second entry that we're going to do is for the sales discount. So we're going to debit sales discounts. And we're debiting that for the discount dollar amount, which is $4,750. And then we're going to credit accounts receivable for the accounts receivable amount. And that's going to clear out the customer's amount so that the customer will no longer owe that money. Okay. So that would be the entry for the payment on accounts from the customer with them taking the discount. Now, if they didn't take the discount, let's just pretend they didn't take the discount. I think that's what B says. B says, assume that Alonzo Company received the payment from Artie Company on January 2nd of the following year instead of December 13th. Prepare the journal entry. So basically what they're saying is that they paid too late to get the discount. So if they paid too late to get the discount, this is how it would look. It would be, they said January 2nd, right? So the date would be January 2nd. And the thing about it is the cash amount and the accounts receivable amount are going to be the same. There's no discount taken. So we got cash, we would get cash of $475,000. No discount taken. And then we would credit accounts receivable for the same amount, which would be $475,000. Okay. All right. So that would be if we did not take the discount.